Welcome to Investment U Forward Guidance. This is the weekly podcast about the news that actually matters to your portfolio. Joining me today is Andrew Snyder. You might remember him as the former editorial director of the Oxford Club, but he recently left to found Manward Press, where he is the editor of Manward Letter, Manward Digest, and the new Manward Trader service. Andy, thanks for joining us.
Hey, thanks for having me, Sam.
So, it's now been about 2 months since you left the Oxford Club to build Manward. How's it going? What are you guys working on now?
Sure. I think the optimal word is busy. So launched Manward Press, as a lot of listeners probably know, it was a passion project of mine. So I'd get up early, 4:30 in the morning, work on it, then go down to the office in Baltimore and work on Oxford Club stuff. And then I'd come home and I'd finish up some more Manward stuff. And it really grew up. It grew up way faster than I ever expected. And so I came to a crossroads and had to make a decision to pursue Manward Press full time or stay with the Oxford Club. And what I'm doing with Manward is really cool. The readers are really liking it. So it was kind of a no-brainer to go out there and risk it and try Manward Press full time. And now it seems like I'm still getting up at 4 or 4:30 and still working late at night. But now it's 100% Manward. And it's really fun. I got to say, what we have discovered is that there's this kind of a scientific study out there from some guys in New York that showed that men need just 3 things to be successful and fulfilled. Those things are know-how, connections, and liberty. And so we've built on those ideas, and we're having just a ton of success reaching out to men and even a lot of women with these ideas, with everything we do. And so, it relates directly into the financial side. Listen, I've been in the financial game for 12 years before doing this, so that it plays a big role in Manward Press, easily a third of what we do. But we're also looking at things that affect men's health, the social aspects of being a man and what that looks like. And it's just been tremendous fun. And for your Investment U readers, the investment side is we're taking a slightly different look at things, and it's been really interesting. Our readers have loved it so far.
Interesting. And you just touched on the financial side, which brings me to my second question. During your time at the Oxford Club, and from what I understand, also at Manward Press, you've been a very vocal critic of the zero economy, the Federal Reserve's policy of maintaining artificially low interest rates. Can you explain your stance on that?
Sure, absolutely. So, first and foremost, I've picked on Janet Yellen to no end and the Fed, and I don't envy the position they're in, but they have got us in a position that A, they can't get out of, and B, I don't know how normal investors are going to get themselves out of this. There's trouble brewing somewhere, and the problem is the Fed has we're 10 years now from the financial recession, and here we are, the Fed funds rate, even after all this so-called interest rate raising over the last year, the effective Fed funds rate is still below 1%. And when we look at central banks across the globe, we're one of the higher ones.
Right.
There's negative rates all throughout Europe, and it's causing a lot of trouble. With interest rates this low, investors just don't have anywhere to go for income. And so traditionally, there were safe places to go get income. Sure, you're not getting the 7, 8, 9, 10% and higher from the equity market, but you're getting something. You're getting 4%, 5%, something that you can, retire on and know is
Right.
going to be there. Now you're lucky to get 1% anywhere. So investors are forced to go further out on the risk spectrum to find income, and that's creating big trouble, and it's creating problems for the Fed, because as they want to curtail the stimulus that they've been doing, they need to raise rates. They need to unwind their balance sheet. But as they do that, like we had the taper tantrum a couple of years
Right.
ago, as they do that, investors lose money. And so now the Fed is stuck between a rock and a hard place. They can either raise rates, unwind their balance sheet, and send stocks, and then the investors, depending on them, into a tailspin,
Right.
or they can meander in this really lukewarm territory we're at now that's equally as dangerous. So there's some big problems there brewing, and that's why I'm not a big fan of this. It's creating a bubble in certain places, and it's creating trouble in others. It's not good.
I see. And correct me if I'm wrong, the kind of yields we're talking about, treasury bonds and whatnot, are the income that retirees and seniors traditionally depend on to live, right?
Sure, absolutely. So the 10-year bond is kind of the benchmark, and that's been falling lately, even as the Fed has raised rates. But that 10-year Treasury is a benchmark for so many other things. The CDs that you get from your bank, mortgage rates, car loans, they all hinge around that. Mm-hmm. And so even as the Fed's been raising rates, those other rates that hinge on that have been falling, and it's creating a lot of havoc in the market.
Right, and we actually have a graph of that in the attached article. And I wanted to ask, why do you think the market has been unresponsive to these rate increases? Why are yields still going down while Janet Yellen is telling us the opposite is happening?
Sure. So if the markets move on fear and greed, the Treasury, the bond market, and the Fed moves on the idea of hawks versus doves. And for the last year, kind of the hawks, the folks that are inflation fighters that want to raise interest rates, have been the loudest. They've been leading the charge. But now, as of the last meeting in June, we're seeing that the doves might be making a charge. We had some dissent from the voting governors about raising rates. It was kind of unexpected. The dot plot, which shows where various folks in the Federal Reserve expect interest rates to be, is showing that interest rate expectations are falling. Mm-hmm. And now we have probably the biggest indicator, and the main reason interest rates are falling recently is because of this idea I mentioned a little bit earlier, is that the Fed has $4.5 trillion on its balance sheet. That's
big number.
That's $4.5 trillion that it created out of thin air, and it has to do something with it. And so for the last year or two, we've been watching the Fed and to see how they're going to unwind that, because a lot of the money in there, a lot of the bonds are maturing, so that's more money coming in.
Right.
And so we're waiting to see what the Fed does with that, whether they roll it over to more treasuries and keep the stimulus alive, or if they just kind of let that money go into thin air. And so we've been expecting them to let it go into thin air later this year, which would be kind of the end of the stimulus. It would start to tighten the monetary supply in the U.S. But now that inflation isn't really all that high and the economy is still lukewarm, the Fed just announced that, maybe next year we'll start to unwind all this. And the market saw that and they said, hey, wait a minute, this is way more dovish than we expected. Interest rates are too high. We're gonna buy some bonds and push them lower.
I see. So in this zero economy, in this stubbornly low rate environment, where do you recommend that investors look for yield and income?
Well, I don't recommend they go to traditional sources. CDs, treasuries, there's trouble brewing. There's junk bonds, there's a bubble building. Even within dividends, so many investors have left the bond world and have put their money into dividends, the only place they can get yields of 3%, 4%, 5%. That things are overpriced. It's overdone. So, there's still some bargains there. Don't get me wrong, there's places to look. But, en masse, there's trouble there. So I've been recommending people look at the stock market a little bit differently. Look at the idea of income generation differently. As so many folks have flocked towards dividend payers, there's a whole new asset class that kind of got overlooked. And that's where people need to be looking. Look for the stocks that have strong asset or strong price appreciation potential, and look at those as your income providers, not just the yield on it. There's ways of generating income that doesn't come from a traditional yield.
So that's interesting. You're talking about using traditional growth investing methods, buying and selling stocks to achieve an income goal. Is that correct?
That's right. And so what we do in Manward Trader is exactly that. We have my proprietary Liberty indicator. Again, there's the triad, know-how, connections, and Liberty. So we're using this to kind of follow the money flow. We're looking for where the smart money is going, looking for stocks that what I found is if you buy them right when they're hinging from more money going out to more money going in, it's a fantastic indicator that something big's about to happen. And we've been generating just incredible amounts of income following that strategy. And again, it doesn't have a yield. One of our stocks is up over 70% in 2 months.
Wow.
And we just locked in 2 plays in less than 2 weeks. They doubled. So in 2 weeks, we're generating enough income that, from these stocks that have doubled that greatly eclipses any of the yield that you're going to get at 3-4% from a traditional bond player. Every stock in our portfolio, as I speak, is in positive territory. So this Liberty indicator is onto something really big. It's generating a fresh source of income that folks are just overlooking in other sectors.
I see. So, as you can see, Andy has a really novel approach to income investing. If it piqued your interest, check out his new service, Manward Trader. You'll find a link at the bottom of this article. Andy, thanks so much for joining us.
Hey, thank you very much.
We'll see you next week on Investment U Forward Guidance.